Wealth Nation, in today's video, we are going to share with you the top 3 mistakes that people make as it pertains to infinite banking and why it costs you thousands of dollars.
Yeah, now the number one mistake that people make is thinking that they can invest in infinite banking or it's an investment strategy. It is not an investment strategy. It is not an investment. You cannot invest in life insurance. Life insurance is a tool used to protect your income. It is an asset. And like any good asset, you have the ability to leverage that asset in order to get a loan from the insurance company. Now, that's where you have to start rethinking what infinite banking is, because it is a cash flow strategy, not an investment strategy.
Very good point. So with that being said, there's people that come to Darius and I and just the Wealth Nation team all the time, and they're like, how much is my investment? And again, we just want to make sure that the vocabulary is clear, because when you purchase life insurance, again, I know I'm being redundant, but I just want to hit the point hard, is that life insurance is first and foremost to protect your income. That's it. Like Darius said, there's perks that come along with it, but the only thing we want to make sure you get from today's video is life insurance is to protect your income.
Yeah, and that puts me in the same mind frame as like your 401k, your retirement plan, where it is for retirement.
Yeah.
But there is perks that come along with it where you can get a loan, you can leverage that to get a loan, and you can use those funds in order to invest.
Yeah, but the purpose of the account is retirement funds.
Yeah, now
right?
here's I think why it's sticky, because what I've heard is a lot of people would use their loans from their retirement and they would consume.
Yeah.
That's the problem. The problem right there is you do not borrow from your life insurance policy in order to get stuff that doesn't produce income. That's a problem. That's another mistake that you make within misunderstanding the fact that infinite banking is a cash flow strategy.
Yeah, and in any conversation, I'm glad that you said that. Whenever you get a loan, we have to recognize that there are costs involved, right? This isn't free money. So it would behoove us to make sure that we are using these loans responsibly in a way that we are making more money than what it cost us to borrow.
Right, so that's point number 2, is the fact that...
You like that segue?
Yeah, I like that.
Now with point number 2, what I'm alluding to is getting a loan and not paying it back. Oh, that's a nightmare. We know that this happens far too often. And again, that's why we want to make sure that you all understand this process of infinite banking. If you get a loan from the life insurance company, you must pay it back. You have to pay principal and interest. That's just how it is, right? If I borrowed money from you, you would want your principal back, and you should want some interest too, because now you have created the banking relationship. So with that being said, what we're going to do is we're going to put on the screen a numerical breakdown so that you could see from a sample policy, again, sample policy, education purposes only, right? This is just so that you can see numbers and you can see how much this is actually costing. All right, so let's go ahead and flip to the screen. And you know what, before we jump into the screen, one little disclaimer that I want to put out there. Again, this is for educational purposes only, and this isn't about policy design or any other nuances. We're just showing you, yeah, we're just showing you how much the premium is, how much your loan is, how much the interest would cost. And I'm going to show you from a 5-year time frame. So don't think about anything else other than the premium, the cash value, and the interest, and how that builds up over time when you do not pay your loans. Now let's get to the screen. All right, Wealth Nation. So as you can see on your screen, I'm going to show you a 5-year time frame of paying premiums and getting policy loans. As you will see with this particular premium, you are paying $10,000 for year 1. The cash value available in year 1 is $5,745. And if you decide to get a loan from the insurance company for that amount, the interest owed on your anniversary will be 5% simple interest, which is $287.25. Assuming that you have paid that loan back, you would owe, obviously, the $57.45 plus the $287.25, and the loan would be paid in full. However, in this example, we're showing you what it looks like when you do not pay the loan. So in this case, you're not going to pay the loan back. Let's say you have it outstanding for another year, so you still have to pay that interest, the $287.25. The next year, you're going to pay your policy premium, which again is $10,000. Your cash value has grown to $11,693. This would be the amount that you can borrow, but remember in the very first year, you already borrowed the $5,745. So the difference between the $11,000 and the $5,700 is $5,948. That is available for you in year 2. Now, let's say we go a full year and you don't pay that loan back. Now you owe $11,693, and the interest, the 5% interest on the outstanding loan, is $584.64. You can see where we're going, right? You've paid a policy premium of $10,000. Now you have an outstanding loan of $11,000 and you have interest almost $600. Let's go to policy premium year number 3. We paid $10,000. Your cash has grown to $19,875. Again, this is the cumulative value, meaning if you haven't borrowed any money, this would be available. But since you've taken a loan out in year 1 and year 2, what is available to you this year is $8,182. The beautiful thing about the cash value is, as you can see, it continues to grow even though you have outstanding loans, but the secret sauce is paying it back. Now, let's say you've gone 3 years, you haven't paid any of these loans back. Now you have an outstanding loan of $19,875, and the interest owed is now $993.75. Hence why we keep saying, if you are going to get a loan, you need to make sure that you are leveraging it in a way where you are able to make more money than what it cost you, so you can pay all of this back and you don't have to come out of pocket. Let's go to year 4. You pay again $10,000 for your premium. The cash that's grown into your policy now at this point is $30,290. You have a loan outstanding every single year. Now we have $10,415 available. Let's say we get the loan again and we don't pay it back. Now we owe $30,290, and the interest owed on that loan is $1,514.50. Year number 5 comes around. In this instance, how this particular policy was designed, the paid up additions rider comes off, which is why you're only paying the base premium. Again, if you want more vocabulary, then you can check out other videos so that you understand these breakdowns that we're sharing with you. But long story short, your policy gets cheaper. So in this case, the policy premium is $4,120. The cash value has grown to $35,436. But again, we have outstanding loans every single year. So now this year, if my premium is $4,100, the cash that I have available that year to borrow is $5,146. And assuming that we took another policy loan out and we haven't paid any of the outstanding loans back, we now have an outstanding bill of $35,436, and the interest owed is $1,771.80.
So thank you, Carmen, for breaking those numbers down. Really appreciate it. Now, the interesting question to answer, or for me to ask, is how do you get to that point to where you're borrowing money, you're not paying it back? Well, there's 2 different scenarios. The scenario that we wouldn't recommend is borrowing money without a plan to pay it back, or borrowing money without a planned investment that would pay it back. The second is that you borrow the money and you're invested in an asset that is taking some time in order for it to produce the income to pay the loan back, which is perfectly fine. The most important thing to understand is that you should be in a situation where you're able to pay the interest back, as it takes time for that investment to produce the income.
Yeah, because to your point, we've invested in properties, for example, where maybe it takes 24 months to produce any sort of profit. And for that, we already knew going into it that we would have to out of pocket pay for the interest for the first 2 years until things started cash flowing.
Like our condo that we purchased back in 2020, and we didn't move in until 2025. It took 5 years in order for the place to be built because, you know, things are a little different. Construction is a little different and timing is different in other countries.
Well, and also it's COVID.
It was COVID.
Which is an exact example why it's important for you to have a plan, like we said, because far too often we know policyholders that continue to get loans after loans after loans, year after year after year, and they have no plan on how they're going to pay it back or even how the interest is going to get paid. Because remember, we got all the way down to $1,717 in 5 years of just interest. And a lot of times people go, whoa, how am I even going to pay the interest if I'm not even going to pay the principal back? Mm-hmm. So that interest, the life insurance company is going to make sure they get their money. So they're going to take that interest from the cash value of your policy if it's available. And if it's not available, then you're going to get a ring, ring, ring. How do we keep your policy on the line? How do we keep it on the hook? Because we're in jeopardy of lapsing your policy.
Right. And
meaning it going away because you've pulled out way too much money and now there's nothing in there to keep it alive.
Right. Now that can also be an issue with policy design. But one thing before we go into the next point is the fact that the money people use in order to buy a life insurance policy is important too.
Yes.
Because if you use money that you actually need to pay your living expenses, then what's going to happen is you're going to end up borrowing money without paying it back, because you actually need that money in order to maintain your lifestyle.
Yeah, I would say that that's number 3. The third mistake is people pay premiums with money that they don't have consistently, meaning it's income that you can't count on every year. So we got a bonus this year, but we don't know that the bonus is going to come next year.
Exactly.
Or
yeah.
we got a windfall this year, but we don't know how the windfall is going to come next year. Whenever you pay your policy premiums, it has to be with money that you know you can count on year after year, because you have to pay your policy premiums sometimes longer than you pay your mortgage. Again, the title of this product is called Whole Life. You're going to be paying insurance for your entire life.
And yes, there are different types of policies that you can buy to support whatever your specific lifestyle need is, but you have to be able to articulate that to your agent when creating the life insurance policy. So I'm really glad you brought that point in. The third point is an amazing point of making sure you use the right money to buy the policy premium, so that 2 years later, 3 years later, you're not going back, because bonuses are nice, but they're not guaranteed. There's no guarantee that you're going to get a bonus every single year. You might have gotten the past 5 years, but next year is a whole new year. You can't depend on that because it's not guaranteed.
Now, what I want to do, Wealth Nation, I want to throw in a bonus point. So we're going for 4 here. And that 4th point is that you need to buy the policy that you can afford today. And you need to buy the policy that is going to go with your specific financial goals. Not the policies that Darius and I get, not the policy that Joe Schmo down the block gets, not the policy that your mama got. You need the policy you can afford today with a design that's going to help you today. Far too often we see people stretching themselves financially to try to pay for a premium that they can't afford, and we're like, time out. Again, you got to pay for the policy year after year. So let's come up with a specific number that makes sense for you, and you don't have to stretch yourself. You shouldn't ever buy a life insurance policy where you have to stretch yourself. We're going to evolve and grow into this whole process. And Darius and I have had policies for almost a decade. We're in the 9th year, or no, has it been 10 years? We just paid our 9th year. We just paid our 9th year. Yeah. Anyways, so the point is we just paid our 9th year premium. And for us, we had to make sure we're 9 policies in, family. So we've essentially, you can say we've gotten a policy every single year throughout this whole process, is because we had the income to be able to afford it. So that's why we want to make sure when you understand this, get to you 1 policy that you can afford today. Next year may be different, and we can look at the options to see if it makes sense for you to get other policies. Why would you get other policies? Is because we need to make sure that your death benefit value, we need to make sure that that's secured. And meaning, for example, if I'm worth $3 million of death benefit, maybe my first policy won't give me the entire death benefit of $3 million. I don't know, that's just an example.
Right.
If I get my first policy, maybe gives me $500,000 in death benefit, then I know I'm short $2,500,000.
Right, and it's important.
Oh, I thought you were saying that's wrong.
No, I like the fact that you're bringing numbers in, because it's also important for people to understand how to calculate their net worth.
Yeah.
Because the insurance company isn't going to tell you what your net worth is. You have to be able to calculate that and decide that how much life insurance that you actually need for yourself. So as a matter of fact, the insurance policies that we have, the whole life insurance policies, they don't cover our entire net worth, which is why we have term to go along with it, so that we can convert that term over to whole life without having to go through any medical exam or anything, regardless of what our health does in the next 15 years. We also have life insurance policies on people who we have insurable interest in, like our parents, our daughter. If something was to happen, then we would be responsible for making sure that the family is taken care of, the expenses is taken care of. So what we wanted to make sure that we do is we cover the whole gamut, because this is, at the end of the day, a cash flow system. It's not an investment, it is a cash flow system. The asset itself protects our income, but the perks that come along with that asset is the fact that we're able to leverage it to create cash flow, which is why we buy real estate, which is why we invest in our business, which is why we make other investments in real estate so that we can continue to make cash flow outside of the income that the active income that we're currently making.
All right, Wealth Nation, now with this video, we hope that it saved you thousands of dollars so that you know what you need to do with your next policy. If you get loans, pay them back, know the interest that's owed, and
Have a plan.
And know that this isn't an investment. Like Darius said, it's a cash flow system, and it's something that you really need to be cognizant about because this is for your whole life.
If you are interested in getting your next policy with Wealth Nation, make sure you click on the link below to start your application.
And remember to own your own lifestyle.
Or someone else will.